Hello and welcome back to Boni's Life, your home for deep institutional grade analysis of the crypto markets. I'm your host, Boni, and this week we are navigating a market gripped by nothing short of extreme fear. The crypto fear and greed index has cratered to a chilling 8 out of 100, a level that screams panic and capitulation. Bitcoin, after a brutal 52% drawdown from its October 2025 peak, is fighting to hold the line around $67,000. But this isn't just a dip, it's a complex, multifaceted deleveraging event driven by a perfect storm of macroeconomic shocks, institutional de-risking, and geopolitical turmoil. This week has been a gauntlet, and we're here to make sense of it all. In today's episode, we will conduct a forensic day-by-day analysis of this week's market chaos from Monday, February 17th through today, Thursday, February 20th. We'll uncover the powerful forces that moved the markets, from hawkish Fed minutes and shocking GDP data to escalating tensions in the Middle East. We will perform a detailed technical analysis using live data from CoinGecko and CoinGlass, simulate a $100 investment to quantify the week's brutal volatility, and review our October projections to see how they've held up. Finally, we'll arm you with 3 potential trading scenarios complete with the technical triggers you need to watch for. This is not just another market update, this is a masterclass in understanding the intricate dance of global finance and digital assets. So buckle up because we're about to go deeper than anyone else. Let's begin with a day-by-day breakdown of this week's market turmoil. We'll focus on Bitcoin, Ethereum, and Solana to get a clear picture of the market's trajectory. Monday, February 17th was a bloodbath. With US markets closed for President's Day, the selling pressure that had built up over the weekend continued unabated. Bitcoin tumbled to $67,191 as the market's correlation to the tech-heavy Nasdaq turned positive, meaning crypto was being dragged down by the broader risk-off sentiment. The fear and greed index plunged to 12, signaling extreme fear, and Bitcoin's dominance rose as capital fled from even riskier altcoins. Tuesday, February 18th, brought the week's most significant macro catalyst, the release of the January FOMC meeting minutes. The minutes were surprisingly hawkish, with several Fed members even suggesting that a rate hike was not off the table if inflation remained sticky. This sent shockwaves through the market. The US dollar surged and Bitcoin plunged to its weekly low of around $66,533. The day was marked by massive ETF outflows, with nearly 2,000 BTC being drained from spot ETFs, and a wave of liquidations that saw over $700 million in short positions wiped out. Wednesday, February 19th, saw a slight stabilization. Bitcoin clawed its way back to around $67,000. However, the macro environment remained treacherous. Geopolitical tensions flared as President Trump issued a 10 to 15-day ultimatum to Iran over its nuclear program, sending crude oil prices soaring and gold surging past $5,000 an ounce. The AI sector also experienced a major sell-off, with Microsoft suffering its worst single-day loss in history, which had a contagious effect on the crypto market due to the high correlation. And that brings us to Thursday, February 20th, a day of truly shocking economic data. The Commerce Department reported that Q4 2025 GDP grew at an anemic 1.4%, a massive miss from the 2.5% expected. At the same time, the Fed's preferred inflation gauge, the core PCE price index, came in hotter than expected at 3.0% year over year. This is the dreaded stagflationary signal, slowing growth with persistent inflation. However, the market also received some positive news as the Supreme Court struck down Trump's emergency tariffs, and initial jobless claims came in lower than expected at 206,000, suggesting a resilient labor market. Bitcoin has been chopping around the $67,000 to $68,000 range, currently trading at $67,347 as we speak. Now, let's delve into the fundamental drivers behind this week's dramatic price action. It wasn't a single event, but a perfect storm of macroeconomic pressures and crypto-specific headwinds that created this vortex of fear and uncertainty. The Federal Reserve's hawkish stance has been the primary catalyst for the risk-off sentiment. The minutes from the January FOMC meeting, released on Tuesday, revealed a divided committee that has decided to pause interest rate cuts for now. The Fed is holding the benchmark federal funds rate at a restrictive 3.50% to 3.75%, and Fed Chair Powell has explicitly stated that rate cuts before June are, and I quote, unlikely. This higher for longer interest rate environment makes risk assets like crypto less attractive. Thursday's economic data release was a bombshell. The Q4 2025 GDP data showed a shocking slowdown to 1.4% growth, far below the 2.5% estimate. This was largely attributed to the government shutdown in late 2025. At the same time, the core PCE price index, the Fed's preferred inflation measure, rose to 3.0% year-over-year, indicating that price pressures remain broad-based. This is the worst possible combination for crypto, slowing growth with sticky inflation, a classic stagflationary signal that makes the Fed's job incredibly difficult. However, there were some glimmers of hope. The Supreme Court's decision to strike down Trump's emergency tariffs provided a positive catalyst for risk assets, and the resilient labor market, as shown by the drop in jobless claims, suggests the economy is not falling off a cliff. The geopolitical situation with Iran remains a wild card, with the potential to either escalate and cause a flight to safety or de-escalate and provide relief to the markets. On the crypto-native front, the ETF era feedback loop has been in full effect. This week, we saw a torrent of outflows from spot Bitcoin ETFs, with a staggering $6.18 billion being drained since November. On Tuesday alone, we saw a net outflow of over 1,980 BTC. These outflows reduce on-exchange liquidity, which in turn amplifies price declines, and this triggers even more redemptions, creating a vicious downward spiral. This was compounded by a massive deleveraging in the derivatives market. According to CoinGlass, total open interest currently stands at $95.44 billion, with $185.77 million in liquidations in just the past 24 hours. The long-short ratio on major exchanges, while still showing a bias towards longs, has decreased significantly, indicating that even the bulls are getting nervous. Finally, the Bitcoin mining difficulty recently saw a landmark 15% increase, the largest since 2021. This makes it more expensive for miners to produce new Bitcoins. With the price of Bitcoin falling, many miners are now operating below their production cost, and we are seeing a decrease in the Bitcoin exchange balance, which now stands at 2.48 million Bitcoin, suggesting some miners may already be capitulating and selling their holdings. All right, let's get our hands dirty and look at the charts. The price action has been brutal, but it has also created some very clear technical levels that we need to watch. For Bitcoin, the key support level to watch is the recent low of around $66,000. If we break below that, the next major support is at $63,957, which is a significant liquidation level. A break below that could trigger a cascade of liquidations, potentially sending the price down to retest the February low of $60,033. On the upside, the first major resistance is the psychological $68,000 level, followed by the critical $70,000 wall. If we can break and hold above $70,000, the next resistance levels are at $72,000 and then the $76,000 to $78,000 zone. The average relative strength index across the market is currently at 44.87, which CoinGlass classifies as neutral. Bitcoin's dominance has risen to 58.18%, indicating that capital is rotating from altcoins into Bitcoin as a relative safe haven within the crypto space. For Ethereum, the technical picture is even more precarious. It has decisively broken below the key psychological support level of $2,000, and the recent low of $1,924 is now the immediate support. The ETH funding rate on CoinGlass is negative at minus 0.0045%, which tells us that short sellers are actually paying to maintain their positions. This is a bearish signal. If the $1,924 level fails to hold, we could see a further decline towards the $1,800 level. On the upside, ETH needs to reclaim the $2,000 level to have any chance of a sustained recovery. Solana, on the other hand, has been a surprising outperformer this week, posting a 4.2% weekly gain while the majors struggled. Its 24-hour volume surged to $9.25 billion, showing strong trading interest. The key support level to watch for SOL is the $82 level. As long as it holds above that, the bullish momentum remains intact. On the upside, the first major resistance is the $85 level, followed by the weekly high of around $86.48. A break above that could see SOL make a run towards the $100 mark. To put this week's volatility into perspective, let's run a quick simulation. If you had invested $100 in a spot position in each of these three assets at the start of the week on Monday, February 17th, here's how you would have fared as of right now. For Bitcoin, with a weekly change of approximately plus 0.23%, your $100 investment would now be worth around $100.23, a tiny profit of just 23 cents. For Ethereum, with a weekly decline of approximately minus 1.86%, your $100 investment would now be worth around $98.14, a loss of $1.86. But for Solana, with a weekly gain of approximately plus 4.2%, your $100 investment would now be worth around $104.20, a profit of $4.20. This simulation clearly illustrates the divergence in the current market. While the two largest cryptocurrencies have been essentially flat to negative on the week, Solana has been a bright spot. This highlights the importance of risk management and diversification in a volatile market like this. Now, let's take a moment to look back at the projections we made in our episodes back in October. At the time, the market was in a state of euphoria, with Bitcoin making a run towards its all-time high of $127,000. We were cautiously optimistic, but we also warned about the potential for a sharp correction if the macro environment soured. We specifically identified the $90,000 level as a key distribution zone, and we warned that a failure to break through that level on a retest could lead to a significant deleveraging event. We also stressed the importance of watching the institutional flows and the Fed's monetary policy. As it turns out, our cautious stance was warranted. The market failed to break through the $90,000 resistance, and the subsequent hawkish turn from the Fed and the massive ETF outflows have triggered the exact deleveraging event we warned about. Bitcoin has now fallen 52% from its peak, and the total crypto market cap has shrunk to $2.395 trillion. This is a testament to the importance of a data-driven, fundamentals-based approach to crypto investing rather than getting caught up in the hype. As Bitwise noted today, Bitcoin remains significantly undervalued at current levels, but the path to recovery depends entirely on the macro environment. So, where do we go from here? Let's outline three potential scenarios for the coming week, along with the key technical triggers to watch for. Scenario 1, the bullish case, which I assign a medium probability. In this scenario, the market continues to react positively to the Supreme Court's decision to strike down Trump's emergency tariffs and the better-than-expected jobless claims data. We would also need to see a reversal in the ETF outflows, with institutional investors starting to buy the dip. The technical trigger for this scenario would be a decisive break and hold above the $72,000 resistance level for Bitcoin, with a corresponding move above $2,100 for Ethereum. If we see that, the next targets would be $76,000 to $78,000 for Bitcoin. Scenario 2, the bearish case, which I also assign a medium probability. In this scenario, the market's initial optimism fades as the reality of the weak GDP growth at just 1.4% and sticky inflation at 3.0% core PCE sets in, ETF outflows continue, and geopolitical tensions with Iran remain elevated. The technical trigger for this scenario would be a break below the recent low of $66,000 for Bitcoin. This would open the door to the major liquidation level at $63,957 and potentially a retest of the $60,000 low. For Ethereum, a break below $1,924 would target $1,800. Scenario 3, sideways consolidation, which I assign the highest probability. In this scenario, the market continues to chop around in the current range of $66,000 to $70,000 for Bitcoin. The market would be in a state of equilibrium, digesting the conflicting signals from today's data release. Weak GDP but resilient labor market, hot inflation but tariff relief. The altcoin season index at 43 and the average RSI at 44.87, both in neutral territory according to CoinGlass, support this consolidation thesis. The trigger for this scenario would be continued trading within this range, with failed attempts to break resistance or support. For the next 24 hours specifically, I would watch the $67,000 level as the pivot point. If Bitcoin can hold above $67,000 and push towards $68,500, that would be a short-term bullish signal. However, if we see a rejection at $68,000 and a drop back below $66,500, that would suggest the bears are still in control. The optimal strategy in this environment is to keep position sizes small, use tight stop losses, and avoid excessive leverage. Remember, with the fear and greed index at 8, we are in extreme fear territory. And historically, these levels have often preceded significant bounces. But they can also precede further capitulation. We are at a critical juncture in the crypto market. The great deleveraging has washed out a significant amount of excess leverage, but the macro headwinds remain strong. We have a US economy that grew at just 1.4% in Q4, inflation that refuses to come down to the Fed's 2% target, geopolitical tensions that could escalate at any moment, and institutional investors who continue to pull capital out of Bitcoin ETFs. But we also have a Supreme Court ruling that just removed tariff uncertainty, a labor market that remains resilient, and a level of fear in the market that historically has marked generational buying opportunities. The extreme fear in the market is palpable, but it is also in these moments of maximum pessimism that the best opportunities are often found. As investors, it is our job to remain rational, to stick to our data-driven approach, and to be prepared to act when the time is right. This is not the time for panic selling, but it is also not the time for blind optimism. It is a time for careful observation, for diligent research, and for strategic positioning. Thank you for joining me on this deep dive into the crypto markets. I'm Boni, and this is Boni's Life. If you found this analysis valuable, please smash that like button, subscribe to the channel, and hit that notification bell so you don't miss our next episode. Drop your thoughts in the comments below. I want to know, are you buying this dip or are you waiting for lower levels? Until next time, stay safe, stay informed, and remember, in markets, the patient and the prepared always win.